It's a real pleasure to have with us today Randall Abramson, who is a co founder, president, and CEO, as well as portfolio manager at Trapeze Asset Management, a leading value investment firm that takes a contrarian approach to investing in undervalued companies that are temporarily out of favor but misunderstood and often underfollowed. Randall, it's a pleasure to have you with us today.
Thanks for having me.
Before we delve into your strategy and your idea selection, could you tell us a bit about your background and the firm and sort of what makes you guys different?
Sure. To start at the very beginning, grew up with stocks because my father was a corporate lawyer and then became a portfolio manager, and so was always involved in the markets per se. We both went through our own careers in the early days and were portfolio managers at different firms. And ultimately he said, "Would you like to join me?" And the rest is sort of history from there because we've been working together for about 17 years now, doing value investing. I don't know that he taught me or I taught him. We both grew up with the school of reading from Templeton and Buffett readings and those types of things. He didn't go to business school. He went to law school and came by it honestly. I, on the other hand, had to, as Charlie Munger says, unlearn some of the things that I was taught at business school through following what some of the peers do in the business. And I don't know that our approach is different from lots of value investors necessarily, other than we tend to prefer companies that have more growth associated with them. We're definitely not what you would call a deep value shop because we're afraid of buying something and watching paint dry for 5 years. And therefore, our preference is to have something where there is both growth and value. Having said that, we're as stingy as the next value guy when it comes to making sure there's a margin of safety within our investment. And I guess another differentiator would be the fact that we are A, Canadian, and therefore find a number of things in our own backyard here, and B, have an all-cap bias, and therefore we end up investing in not just large and medium, but also various small and the odd nano cap. Other than that, we have some proprietary tools which we can talk about as part of our conversation as well, which sort of differentiate us from a lot of other people out there too. And unlike a number of value managers, we also have a mandate from our clients where they authorize it to short sell as well.
How much use do you typically make of that authorization?
It depends. If we despise the markets, then we may go 40% short. Wish we had used more of it in the 08-09 debacle. That was more of a panic than the market declining because it was overvalued. Back in the 2000 through 2002 period, we were at our maximum short on 2 or 3 separate occasions because we did feel that lots of stocks were at nosebleed levels.
You mentioned or you alluded to some proprietary tools that you guys use. Could you elaborate a bit on that?
Sure. One of them is called TRAC, which is an acronym for the Trapeze Ratio of Adjusted Capital. And what we're doing there is we're literally taking the adjusted book value of the company and we're plotting that. And what we've discovered over time is that stocks tend to inflect up or down from various price to book value ratios. And the ratios we use are the same for all companies because they're based on mathematical constants. And that allows us to better time our entry and exit from a position. And so we may trade a position if it gives us a sell signal in our work because it's inflected down from a ceiling, and then buy it back when it gets to a floor.
What kinds of adjustments do you make to book value?
That's the proprietary aspect, but it's not a major adjustment is what I'll tell you. So most companies are very close to their book value in terms of how we plot the graphs.
What about oil and gas companies that may have very different book values and PV10s?
Right. Good question. Interestingly, whether it's a biotech or an oil and gas or a software company, doesn't really matter. Every company in the world we've found, Japanese, Canadian, US, or otherwise, is benchmarked off of book value. Where a company trades, though, is going to depend on two things: what it's truly worth. That's the ultimate magnet that pulls in the stock value or the stock price towards that value, and perception, which is what matters in the short term. That's why our favorite quote is the Ben Graham quote, where he mentions that in the short term the market is a voting machine because it's all about the psychology, but that in the long term it's about a weighing machine because it's about the fair market value and the cash that the business is generating. So in the short term, what we're trying to use is these price to book value ranges to capture that market psychology. And so when I liken it to when there's an oversupply in the stock because there's an institution that's selling, they're getting redemptions, there is a misperception in the marketplace, what have you, the stock will typically inflect off of a specific price to book value band and then keep falling until it gets down to another level of floor in our work, at which point that typically happens because there's enough demand that comes in for those shares, or the selling dries up and demand exceeds supply, allowing the stock to go back up again. But that's just short term. In the longer term, we use another tool, which is called TVM, or the Trapeze Valuation Model, where we essentially do a discounted cash flow. We dumbed it right down, went back to Finance 101, and said, what is the value of a company? And what we ended up with was a formula where the trickiest part of the discounted cash flow formula was not coming up with the weighted average cost of capital, because everybody basically knows what that is. It wasn't coming up with what the next year's forecasted cash flow is going to be, because we can project that reasonably easily too. It might not be entirely accurate, but we can project it easily. But the most difficult part was coming up with the growth rate and what the market thinks the growth rate is. And so what we discovered was that by measuring actual growth and implied growth and taking a delicate balance of the two, and looking back at the last few years to see where normalized revenues and margins were, we could then do a connect the dot off of the last number of years and come up with a plot of the value of a company that in most companies, ones at least that have earnings, is very close to where the share price is most of the time, call it 80% of the time. Of course, there's those outliers, and that's what we as value managers are trying to pick up, either where the company is overvalued and shorted, or where it's undervalued and a margin of safety to buy it. And our raison d'etre is to attempt to buy those companies that are trading at less than 70 cents on the dollar.
How difficult is it for you to identify those types of companies, and how many investments do you typically have in the portfolio at any given time?
We typically have anywhere from 20 to 40 names within the portfolio. The difficulty depends on the market environment. Right now, it's quite easy because while the overall market at the moment, meaning if you look at the value line, is closer to fair value because it's pushing 16, 17 times earnings. And in our own TVM world, we're seeing the TVM lines and the prices for most of those stocks coincide. There's a bifurcation outside of that where the S&P 100, the S&P 500, the larger caps are still down in the 12.5, 13 times range, and therefore are more at 80 odd cents on the dollar. And then you've got small caps, not all of them, but quite a number of them, particularly in Canada, where the venture exchange remains at a significantly low level versus where it was back in 2007. It's still less than half of where it was at the peak. So there are some extreme values to be at out there in smaller cap land too.
And I see as one of your top holdings a venture traded company, Manitok Energy. I don't know if I pronounced that correctly, but
yes, you did.
Could you tell us the thesis on that company and why it is undervalued?
Right. The thesis on that company is that they are worth about $3.50 a share today, and growing significantly. And the $3.50 is a net asset value. They've just guided, literally as of a week ago, so it's very fresh, to 4,000 barrels of production by the end of this year, so exit 2012. The cash flow that will throw off is $55 million annualized. And the market cap of the company at the moment is, I'm going to pull out my calculator, it's about $1.45 a share price times 61 and change million shares. It's about $90 million Canadian, same as US. So you're trading very low on a cash flow multiple, but I like to look at it because I like to look at most of our companies through a free cash flow lens. And to maintain that 4,000 barrels of guidance ad infinitum, they would have to drill about 3 wells a year, which would cost them about, on a conservative basis, $6 million a well or $18 million. So if you take the $55 million of cash flow and deduct, let's take a round number and deduct $20 million with a little maintenance capital spending in there, and you get $35 million of free cash flow. Again, divided by 61 odd million shares is about, call it 55 cents a share. 55 cents a share out of $1.45 of share price, we're talking about a 38% earnings yield or free cash yield. Now, it's hypothetical because they're going to take all of that dough that they're making and redeploy it into capital spending to keep growing the business. But it shows you the cheapness of the business. And one would say, well, why aren't they taking the dollars if that's how cheap it is and paying a big dividend or buying back shares? And the answer is, when they drill a well, this isn't wildcat exploration, this is development drilling. They're going into existing areas where their management team that spent many, many years working for Talisman, drilling 50 to 100 wells a year in this exact area that they're now drilling on behalf of Manitok. They get typically up to 100% IRRs on their drilling. So we would rather than take that cash flow and redeploy it and grow it into more cash flow. And when we look forward, we see the company generating that guidance for this year is an exit rate of $55 million of cash flow out of 61.5 million shares, 90 cents a share. We look forward in 3 years' time, we see them getting to about over $1.80 in cash flow per share.
What kind of PV10 or reserve values does this company have?
That was the $3.50 number I used before.
Okay.
Which isn't that's not the divulged PV10 at the moment. That's our best guesstimate of where it is right now. At year end, I think, if my recollection is correct, it was just shy of the $2 mark. But given what they've now boosted their production to and the discoveries they've made in the last couple of months, I think they've drilled now 3 wells, and they're 3 or 4 for 4. So they're batting 1,000 at the moment. They're due out in the next couple of weeks with a couple more key results. And because this is development drilling, it should be more than 70% chance of success on every drill they drill. And their type curve expects about 265 barrels of oil per well. And so far they've been coming in well ahead of that. The management team is conservative to a fault.
So you like the management at the company?
Absolutely. Terrific management.
It's a big difference to a company we've gotten familiar with over the past few years, Compton Petroleum, which has been a disaster in terms of management. I also saw you do have a natural gas company that you mentioned called Corridor Resources, and I bring that up because we've heard from a couple other investors just very recently that this looks like an interesting risk reward because the company has no debt.
Right.
What kind of fair values do you see there?
I think there's at least a few dollars a share of value in Corridor, and we're only paying 80 odd cents at the moment. As you point out, there is no debt. In fact, there's cash on hand. By the end of the year, they've just forecast they'll have about $12 million in working capital. And there are, the way we look at it, the key field, which is their McCully field in New Brunswick, has a hard value of, call it about $1.50 a share at these silly natural gas prices, and material upside should gas prices finally zoom back up. I noticed yesterday that the drilling rig count has now dropped into the low 600s from wherever it peaked at. Certainly a year ago was more like it's down 30% over the last year, and I think it peaked out at over 1,000. So I think it's, by definition, as they drill less, you're going to have a lesser supply. In the meantime, you've got more demand as people have switched from coal to gas, and as you've added natural gas to vehicle fleets, beginning with trucks and cars soon to come as well. If we can stop having these really mild winters that don't feel like winter at all. Here in Toronto, I think I took my shovel out 3 times. I can hear my wife cringing because she probably took it out a couple more than that. But this was whatever it was, the 3rd warmest winter on record. And that's obviously going to affect natural gas prices.
Sure. And so when you look at a Corridor, it's just surprising that it trades where it does. You know, you might see that with a company that truly is in distress because of a debt load, and the question is how are they going to make it? Yeah, go ahead.
I think the issue is it's in a holding pattern at the moment. And that's because they've got, outside of the McCully field, which is the hard value, they've got 3 key projects. One is Old Harry, which is rank exploration, potential 2 billion barrels of oil in place. in the Gulf of the St. Lawrence, which has been delayed because both the Quebec government and the Newfoundland government sort of haven't agreed to allow it to be drilled yet. And it's 60% one province and 40 the other. The other project they have is called the Frederick Brook, which is a natural gas project, massive 1,000-meter thick shale that is amongst, if not the thickest, gas shale in North America. But again, there, because of gas prices have been so weak, you have not had Corridor land a partner yet, which they need to drill up the project. They can't drill it off with their own meager funds at the moment. And the third project they have is on Anticosti Island, which is an oil shale project, which is analogous to the Utica shale, which looks extremely promising from the shale cores that they've drilled. But again, they'd have to do some further work there and are looking for a partner to bring that to fruition. So right now, the company, to use a mining term, is on care and maintenance, awaiting a partner on any of those projects to happen. Why it's so intriguing from a risk-reward ratio is if any one of those projects even have to work out, the stock is worth many dollars a share. But in the meantime, it's in a holding pattern until we can, as us Canadians call it game on again.
It seems like a perfect contrarian investment because it's not something that other investors can get excited about right now, and yet the value is clearly there.
Correct.
Stepping back a bit from these specific ideas, could you tell us a bit in general what are the main criteria you look for in an investment?
I think the first thing we're looking for is a sound business and one we can understand, where we can reasonably easily forecast where it ought to be in a few years, so that we can make that 2 or 3 year forecast on where we think value ought to be, divided by the price today, and come up with a potential rate of return, so we can benchmark it against all of our other potential opportunities. So it's got to be operationally sound first and foremost. Secondly, it's got to be financially sound. So like our Corridor discussion, or in Manitok's case, I like both because neither of them have any debt at the moment. And so nobody can take them away from us. I don't have to worry about dilution necessarily, perhaps in a Corridor's case, because I'm going to have a partner in some of these projects, but that's just fine. But if I don't have to worry about anybody taking the company away from me, I've got no financial risk. And the third issue is a compelling valuation. And that's another differentiator for us, because we won't look at anything unless it's got at least a 20% potential rate of return over the next 3 years annually. And that doesn't mean we're trying to shoot the lights out. That just means we want to make sure there's enough of a margin of safety to give us that type of return. So if we're wrong, we still end up coming out okay in the end.
You also mentioned that Manitok in particular has good management. How do you actually go about assessing the incentives and the quality of management?
That's hard. It's always hard. And just as you finish assessing the quality of management, like we might have done at Best Buy, for example, management's out and there's someone new coming in. So it's not easy. Our preference is actually to deal with the culture of the organization, and most importantly, look at the metrics. So when we're charting our fair market value and looking at that trajectory of that fair market value, playing librarian to see how they've done in the past, and then extrapolating that out into the future based on where we see the world unfolding for that business over the next few years. That's the most important thing for us. Though what we want to try to avoid is poor management, because we have made mistakes in the past where we have invested where management was frowned upon, didn't have the best reputation, and we thought, well, the business assets are too good. And unfortunately, in those cases, not that we've done a scientific study, but I would say more often than not, management went and fouled up those fabulous assets. So we don't need to have the best management, but we want to make sure we don't have bad management.
Yeah, I can certainly concur with that from personal experience. Prem Watsa has given Canadian CEOs a good name, but for those of us who are outside of Canada, it's hard to really get to know a lot of Canadian CEOs. Could you perhaps tell us a couple of others that might be a bit under the radar, but that you really respect?
To be honest with you, there are some. The fellows who run Canadian Natural Resources, CNQ, have always been looked upon in a terrific light, and they've been spectacular managers. But most of them are guys who just plug away. And I don't know that there's any outstanding manager. We don't have a Warren Buffett of Canada at the moment that I can point out to you. There have been some of the bank managers who have been terrific at running their companies. The guys who ran the Royal Bank have been superb for many years at running their bank. The guys who run Bank of Nova Scotia have done an amazing job. Ed Clark at TD has been spectacular. At Canada Trust before that. So there are some CEOs, but most of them are roll up your sleeves kind of guys who, for example, in one of the positions we own, like Legacy Oil and Gas, where a very smart guy, hardworking guy, who once before took a business recently from 500 barrels to several thousand barrels and sold out, and he's doing it all over again, and he's now got a 16,000 barrel a day company in Legacy. And they own about 9% of the company and are just shrewd at what they do.
Has the market volatility that we've experienced over the past few years affected your investment process, and have you tweaked your approach at all as a result?
We have. The one thing that we've sharpened our pencils further to make sure that our bottom-up analysis is going to avoid permanent impairment. So less of a threshold for the unknown, less of a threshold for anything that might have debt, to make sure that nobody's going to take anything away from us. At the same time, we continue to improve our track work, which is the adjusted capital work I mentioned at the beginning. We added an econometric model so that we can perceive the next recession coming. And we've backtested back to the 20s, and it has typically given us a 270-day advance warning of a recession, so that we might want to lift our shorts or raise cash or get more defensive or buy puts when that model goes off. At the same time, we've got something called TRIM, T-R-I-M, which is a relative indicator of momentum, the Trapeze relative indicator of momentum. And that is an algorithm that essentially takes the pulse of the market. Think of it like a 200-day moving average, but it also has an aspect of volatility analysis in there, and it tends to hug the market. And what we use it for is to find those periods like '08, where the market's about to panic, where it's going down not because it's coming down towards fair value, but maybe it's at fair value and falling anyways because we're having some other crisis or two like we had in '08 that the market's reacting to. And we backtested that back to also to the 20s, but the stats from World War II are there were essentially 10 declines of greater than 20%. 9 of them were captured by trim and a breakdown through the trim line. There were no false signals, so we never said get the heck out and then the market didn't collapse, which is important. And the only one big miss it had was the crash of 87, because I don't think anybody's model is going to pick up something where the market falls 23% in a day. But it captured 80% of the decline from the breakdown through the trim line to the trough, and the average decline was 23%. So I hope I don't have to use that, but I know I will, because every few years the market does have that type of move. And unfortunately, we missed the last one in '08 because we, like others, were blindsided by that and the magnitude of it. And so we're now following not just the U.S. market, but the Canadian markets and several other markets around the world with the trim tool to make sure that we don't miss that kind of thing again.
Now, when, let's say, the trim gives you a sell signal and you sell, what do you use to decide when to buy back in?
The trim would start declining, and so a move back up through the trim line can get you back in. Hopefully we pick it up before that using the track work, because we do also do the track work on indexes and sectors. And if I look back to the last debacle, our trim signal went off. In other words, it gave a stop sign in retrospect in January of '08, and then gave a buy in July of '09. Though we bounced perfectly off of a track signal on March of '09.
Now, how does this correlate to just a straight up valuation-based signal, where you sell when the market is expensive, maybe in terms of a market cap to GDP or Tobin skew or something like that, and then buy back when it's really cheap?
We've looked at a whole host of things, and we haven't found that those things work very well. And in fact, we've looked at other moving averages too, whether it be 150-day or 200-day, and we found those to be sort of 50-50, 60-40. That wasn't good enough for me, because I don't want to get caught with false signals where we yell that the sky is falling and it doesn't fall. There's enough people like that out there. And the other thing that we added in our world is more of a bias towards larger cap names, where for many years we focused on some of the smaller cap names, because that's where all of the value was, going back into the early 2000s, late 90s. And at the same time, the volatility wasn't the same as what we've witnessed in the last few years. So now that the values are there again in the big cap names, we're quite happy to be buying those at silly prices.
One big cap name that you mentioned as a top holding is Dell. I think it's still a big cap name.
Yes.
Could you tell us why you consider Dell to be a bargain at current or recent levels?
Sure. I think that Dell, on the face of it, is trading at about 8 times earnings, which in and of itself is cheap. But that's obfuscated by the fact that they've got a lot of, or what is obfuscated is the fact that they've got a lot of cash in the balance sheet, and that the working capital of the company is still a net positive and adds to the free cash flow. So here's a company that is trading at about 4.5 times free cash flow when you add a little bit of the working capital draw to their net income and deduct the huge cash hoard that they have from their enterprise value. At the same time, I think one of the reasons that Dell is being mispriced at the moment is that there's still a perception that the company is a consumer PC company. I hear people call it Dell Computer all the time, whereas that's now a negligible portion of their business from a profits perspective. They have morphed into a server purveyor. They're selling a lot of services, software. They're big in the cloud now. There's a number of different things the company is doing, which has at the same time lifted their fair market value in the last couple of years, which I think has gone unnoticed, or the market is saying they don't believe it's repeatable yet until they see more time elapse. What we like at the moment is that it's so cheap right now, they could have net cash equal to the share price in just over 4 years.
How satisfied are you with their capital allocation? Are they buying back enough stock?
I would like to see them buy back more because their stock is so cheap. I'm not sure what they're waiting for. Maybe they're reticent because their capital allocation in the past was not great. They did spend a lot of time buying back shares at much higher prices. So that's obviously a concern. And maybe they have that in the back of their minds. At the same time, they've been using dollars to make acquisitions. And I think that's been paying off in spades because they can take those acquisitions and really lever off their massive global distribution channel and take it to the next level. So that you do get true synergies in Dell acquisitions.
Now, in terms of Dell's global competitiveness, it seems Lenovo has been gaining share in that market. HP has been losing share. How do you see Dell positioned over the long term?
I think we're talking again the PC market, so that I don't think that necessarily matters for them, because again that's a negligible portion of profits unless they were to start losing a lot of money there, which is not the case at the moment. In fact, the profits have been growing from the PC side of things. What's more important to me is where they are positioned on the server side, selling to enterprises, and everyone I speak to anecdotally, in every survey we read, they're coming out near the top. We, in fact, ourselves bought a Dell server recently, and if you were to talk to IT consultants, I think you'll hear that where their products a few years back may have had some issues coming out of the boxes. Right now, they have a better price point because of the Dell competitive advantage and the way they're set up. The system comes configured to your liking and to your specs, and at the same time their warranty is cheaper and better, meaning a rep will come out within 4 hours to fix a broken down system. And so that's giving them some serious advantages still, and while they're integrating the software, the services, and the servers, I think that's allowing them to land these very large contracts with major companies as well, which gives them a better lock than just selling a commodity computer.
Shifting gears perhaps to your general approach, what sort of mistakes are you particularly mindful of and try to avoid at Trapeze, and a corollary of that might be what kinds of mistakes do you think investors are most prone to making in the market?
I think our biggest mistake is one of it's a perfect corollary. We're too patient sometimes, and investors aren't patient enough. How's that? And what I mean by that is our biggest mistakes have come from overstaying our welcome at a company, not recognizing, I hate the adage, but where there's smoke, there's fire, and realizing that the business has taken a turn for the worse and is unlikely to improve near term, in which case we should be getting into something else because there's thousands of potential investments out there, as opposed to individual investors who sort of invest, I'll call it hot potato style. And they'll move from one investment to another. You've got average holding periods that have dropped down to less than 6 months. And institutions are culprits of that too. But then you've got, I think I read recently that the average money manager stay now is less than 3 years. The average mutual fund stay is even less. And that does not make for long-term investing.
In terms of the investment climate in Canada versus the US, how do you compare the two? Where do you feel more comfortable? And are there any big differences you see between the two countries in terms of corporate governance or any other major issues related to investing?
I think the biggest reason why we participate in both countries is that from one perspective, the U.S. has the best companies in the world for the most part, whether it be the Walmarts or the Johnsons & Johnsons, the Microsofts, the Apples. These are U.S.-based multinationals. Canada used to have a number of those. We had Nortel at one point. We still have Research in Motion, but that certainly is not the company it used to be. Bombardier is not the company it used to be. We don't have those same sort of consumer staple type companies that the U.S. has, where you can invest in them normally through thick or thin. Having said that, in Canada, we have smaller, off-the-radar growth vehicles that are resource-based in an era where the developing nations of the world are reliant on commodities. And so as places like China and India continue to grow because their populations are growing and continue to urbanize as they develop, they need more stuff, be it oil or otherwise. And so we remain attracted to oil from a top-down basis. And if we can find oil companies that are trading at a fraction of their fair values and growing remarkably, that's what we want to do because all of our stars are aligned.
Do you also have a top-down view on natural gas specifically?
I do, but it's been wrong for the last couple of years. I'm not sure I want to share it with you.
Well, you're not alone in that
right.
department.
Yeah, it's a tough one. We like Boone Pickens and other people out there see natural gas as a clean burning fuel of the future. Having said that, there's been a confluence of factors like weather, meaning mild weather, like shale gas and the incredible finds that have been made in the various basins in the U.S., like the Bakken oil drilling and the fact that that oil also comes with natural gas liquids, and therefore all of a sudden you're doing a lot of oil drilling and you happen to have gas too, has created a near-term glut in the product. Having said that, when you get the drilling rigs declining the way they're declining, when you've got the switching that's taking place, when you've got a 52-to-1 oil to gas ratio, to us that is wholly unsustainable. over the long term. And just think, a few years back, we were talking about the LNG facilities being built in Louisiana to bring gas into the country. Now they're busy reversing them to go the other direction. But they don't get reversed until 2016-ish. And so we're going to be right ultimately, but it might take another 2 or 3 years to be right. The funny thing is most gas companies, like typically cyclicals do, are trading at high prices relative to even an adjusted higher gas price earning stream for those companies, which is why we prefer, other than a complete standout like a corridor, we prefer to be invested in something like a legacy oil and gas, which is 85% oil trading at 70 cents on the dollar, even using $85 oil, worth $12 today, trading at 8, growing to 25 in value, we believe, in the next 3 years, based on the 1,200 potential drilling locations they already have on the books. And Manitowoc would be a similar, as we discussed before, example, because it does over 60% oil.
Interesting. Randall, are there any, just to close it up, are there any books that you've enjoyed over the past few years that you think should be on every investor's bookshelf?
I think that James Montier's Value Investing Tools and Techniques for Intelligent Investment is terrific. That was back in '09, I believe. And I really enjoyed Ken Fisher's The Market Never Forgets, which I think just came out earlier in the year. I think I read it over Christmas vacation.